Hey folks, welcome back to the channel. This is Jason. I hope everyone had a nice weekend. Happy to talk about stocks. Let's talk about recovery stocks. I don't think that this bear market is over with by any means. I think we got quite a bit more ways to go in terms of being rough. But guys, notice how calm I am. Okay. It's because I've been around the block before. I've been through bear markets before. They don't last forever. This isn't the end of the world, but this time it's different, Jason. Of course, it's different this time. It's always different than it was the last time. And I can tell you from experience, it's always the end of the world. And it never ends up being actually the end of the world. The best we can do right now is to earn a little bit extra money if we can, make our investments now while asset prices are low, and wait for a better future. So let's start talking about some of these better stock ideas that you have. Did want to bring up one little thing in the news today. This came out today on Monday. Oil futures fall back in volatile trade to their lowest prices since January. And kind of what's more exciting about this is that West Texas Intermediate crude for November is still holding pretty strongly at about 77.60 a barrel, which so the economics of oil extraction are not really well understood by the general public. They go out and they do a little Googling and they see that it costs the United States about $36 per barrel to get oil out of the ground. That doesn't tell the entire story at all. There are some oil fields where it's $20 per barrel to get it out of the ground. And there are other oil assets where it's $83, $86 a barrel to get it out of the ground. So we have plenty of companies, especially smaller, more regionalized companies that don't have a diverse portfolio, that will lose money at West Texas Intermediate being $77.60 a barrel. They will not increase production. So despite the fact that oil prices are, because of the price that oil prices are falling here, and we have seen improvements in inventories and that sort of thing, I actually think that if oil prices kind of hang out at this level, we're going to see a lot of capital discipline from companies involved in pumping. Some of them will continue to pump no matter what because of the expense of like firing workers and then rehiring them when there's a labor crunch. Some of them will elect to stop pumping at this point, and that's going to be up to the portfolios these individual companies have. So this is not the great sign that you may think it is. It may be setting us up for another supply crisis later on down the road if some of these producers that have higher pumping costs decide to cut back and stop pumping at this point. Although stopping pumping is also an economic decision, and a lot of times companies keep pumping even though they're losing oil because it's more costly to stop and then later on go back. There's a lot of fixed costs that don't go away just because you're not pumping as well. So I'm not going to go into all that today. I just want to say that oil futures falling back to the lowest prices since January, not actually necessarily the best news in the world. Natural gas prices, though, are what you probably should be paying attention to. That's going to say a lot about what's going on economically. So happy to talk about different stocks today. Did want to talk about what's going on in the stock market. Dow Jones down again below 30,000. That number for some reason is psychologically important to some people. I've seen a lot of YouTube videos lately, and I've gotten a lot of emails from folks that keep mentioning the number 30,000 for the Dow like it has some magical or mythical importance. It's not. And really it's just the magical or mythical importance for you at this particular age right now. The market doesn't actually care what the valuation of the Dow is or anything like that. Just to give you an example, my mind is still stuck at at 10,000, right? So, meaning that was the magical and mythical number that I thought the Dow was going to have trouble crossing back, and I don't remember when it did it, like 1999 or something like that, or 2000. Well, whenever it happened, that is when my brain got stuck, right? So when I hear the Dow was down, 302 points today, I'm thinking 3% when it's actually 1%, right? So it's actually, it's just the way your brain gets stuck on these narratives and these, and these numbers doesn't make a lot of logical sense. Michael Will says, isn't the drop in the prices caused by the 180 million barrel release from the SPR? Not even close. Not even close. It's been First of all, I need to actually verify that number with 180 million barrels, but I don't think it's 180 million barrels. But that's not even close. Our oil usage here, just in the United States, I don't know what it is worldwide, is around 10 million barrels per day. And the maximum we've ever pumped is about, well, maybe even more than that at this point. So no, and worldwide it's a lot more than that. But I don't think it has to do that much from the SPR, especially when you're looking at the type of oil we have to acquire in order to replenish the SPR. Most of that is actually not going to come from sources inside the United States. It's going to be bought on the global market, and that's to do with the type of oil that we produce and the prices it goes for. Not there's a lot of weird politics that goes on with the SPR, which it's not a political. It shouldn't have been used as a political tool. It was really that oil release from the SPR didn't really affect prices at all. All it did, it was just psychological. It was just the administration saying, "Hey, we're doing something about this." This will be used over and over and over in your lifetime as a political tool, and it actually doesn't matter that much. It's not really making a dent in the global market. And like I said, it's sold at market prices to whoever the highest bidder is as well. It's not like it's just going to American companies or something like that. That was one of the big things of conservative media that I found hilarious, is that they were saying, we're releasing oil from the SPR and Chinese oil companies are buying it. It was just released on the open market and people bid on it, and it was sold to the highest bidder. That's it. That's all it was. And I think it was divided up into like 12 different tranches. And there was a Chinese company that won one bid. And then certain media outlets freaked out about it. You didn't see anything covered on actual business news or anything like that, because it's not business news. It was only political news. So hello. Sparked Interest says, everyone feeling the pain. Yes, everyone is feeling the pain right now. And I want to acknowledge that. I don't want to gloss over that, guys, that everyone's feeling the pain right now. I do want to talk about, though, what is your best ideas for recovery stocks. I did a video on that a few months ago. It didn't get a ton of interest, but I covered a bunch of like financial stocks that are out there, like more established financials. And then in my Patreon group today, I shared an article from Barron saying that I don't want to alarm you, but I think we're returning to a period, where everything is normal. And when I say normal is a lot of guys who watch my channel aren't even old enough to really remember what being in a bear market is like, and going through a long bear market. If you look at the dot-com crash from 2000, 2001, 2002, the market was down 9, it was down 11, it was down 22, right? And this was a long period of time for people to lose money. 3 years is a long time for me to lose money. And because of how I was invested at the time, a lot of oil stocks and a lot of financials, and less in the way of tech than I have today, that I will admit that dot-com crash didn't affect me as much as it did other people. And a lot of it was because I worked in the financial industry, so I had a ton of financial stocks. But even so, I watched a lot of people just get sort of permanently discouraged from buying stocks because it was 3 years of losses there. So this time around, it is different, and it's not different in a lot of different ways. We had this huge run up in the values of stocks that are a long way away from profitability. A lot of that is in technology. A lot of that is in green technology, alternative energy sources, and that sort of thing. It's not that these companies won't be profitable someday, but the estimation of how much those future profits are worth is changing now that interest rates are rising. We're doing things called repricing things in terms of the present day cost of those future cash flows. So, yeah. So commodities, uranium, oil, liquid natural gas. Liquid natural gas, certainly, I think would be a good commodities in general right now. They tend to do well in an inflationary environment, although this is an odd market period. And I said this last time on my live stream that when I was talking with my buddy Lauren, is that gold is supposed to be this anti-inflationary hedge. And I don't know why that's stuck in people's heads. It's supposed to be this anti-inflationary hedge. It isn't really that. It's just something that has value across cultures. It's one of the great, like in the absence of the age of electronics, right? what value did gold really have? You can't make tools out of it. You can't make weapons out of it. It's just pretty. It's just shiny. What value did it really have other than the fact that it was pretty and shiny? Well, the answer is really none, but it's a lie that everyone on the planet believes. And it's an asset class that is worth something all around the world. Just about everyone will take gold in payment. But has it ever really been a hedge against inflation? The answer is no. And even in the case where we're looking at inflation in the time when they didn't really have paper money, where all they had was like printed coin and actual gold, and we're talking about like North Africa when Mansa Musa made his Hajj, I think in the 900s or something like that. He caused an inflationary episode there because he brought so much gold with him. He caused an inflationary episode there that lasted for something like 200 years. Right. There was inflation in North Africa for like 200 years because of how much gold this guy brought when he went on the Hajj. Right. But there has been this narrative stuck in the heads of people that gold has to be a hedge against inflation. Well, that's not necessarily true. While in the 1970s, it did act as an hedge against inflation. That hasn't been the case since about the 1980s. It's not been as clear cut when you go back and you look at the actual data. So that is something that you should take a good look at. And then I was just reading an article this morning on Barron's stating that this guy thinks that the price of gold has to fall to about $700 an ounce. Right? I'm not a gold bug. I don't keep a ton of gold in my portfolio. I keep a little bit of physical gold just for like running, like I said, running away if I need to, like pick up and move my family to a new country or something like that. But if gold dips down to $700 an ounce, I will be buying gold. And I will be buying gold as an investment at that point. But even at these prices at $1,600, the amount that could move in the time horizon that I'm used to investing things in like 5 to 7 years, it doesn't look all that attractive to me. So uranium. So there's no supply constraints with uranium. Uranium is a lot more available than people think, and it's actually available in countries that are very friendly to us. And one of the huge company, there was a huge Russian company that owned a uranium miner out of Canada, and as far as I know, they've had sanctions slapped on them. And they'll pretty much only be able to sell to us, and then we will hold the assets for them in escrow or something like that. I'm not sure how that's going to work with sanctions, since I don't actually work in a bank anymore. I haven't received any of those briefings yet, so yeah. But commodities are one of the things I would look at. Things like a commodities ETF might not be a bad way to go right now. You're looking at things like corn oil, corn, wheat, seeds. All these things are probably going to be higher in price beginning spring of next year. Especially, I think seed oil is going to be higher in price, and not just because of the war in Ukraine. There's been a bit of a climatic incident in Canada where a lot of seed oil is grown, manufactured. And it's actually been probably most acutely felt already by people that are involved in the mustard trade. There is a mustard crisis going on right now in countries that like eat tons of like specialized mustards, like France in particular. It's really hard to find good mustard at this point. Most of the mustard seed is actually grown in Canada. They've had some climatic events there, and there's been a crash in production. So we are looking at, like I said, spring, I think, is going to be when we see the price of all commodities start to rise. So from what I gather so far, the market will drop even more. Yeah, possibly. Like I think the market right now at 3660, 3657 for the S&P 500 today, right at about 3600 would be fair market value for the top of our credit cycle when I did the math sort of back in January, right? 3,600. I think the market was at like 4,200 or something then, and 4,600 would have been fair market value, right? So the market tends to drop below fair market value. There's not just a repricing back to fair market value. It tends to drop below fair market value for a bit. I'll be honest with you. I don't think it drops much further than 3,600. I don't think it drops much further. Let's say 3,300 would probably be a bottom end for this, because I think that, especially after Powell's speech, that it's not just this 75 basis point rise in interest rates. We know there's going to be more before the end of the year. And I think that the market likely thinks that interest rates are going to be higher for the future. And you should be really looking at companies right now that have good current cash flows. You should be looking at more thinking about value right now than in terms of growth stocks for a lot of different reasons. You still want to hold on to some growth stocks. You got to swing for the fences, but in an investment portfolio, you need to hit a lot of singles, and you can win the game by hitting tons of singles. And a lot of that is ETFs, diversifying your investment portfolio, and of course, value investing in this case, where you're buying good companies that have good current cash flows, and that sort of thing. So I wish I had a good idea. I'm hoping renewable stocks will hold up. So I don't think the stocks will hold up in the near term. I think most of those are going to fall apart in the near term. But I think that as the stock market kind of continues in a way here, we're going to see further on down the road that a lot of these renewables companies, while they're losing money right now, their earnings growth looks pretty good. Their costs are declining, and they have a pathway to profitability when it comes to a lot of this. But depending on what you own, you really need to make sure that that's true, because for many of those companies, that is not true. I'm just thinking of the ones that are in, even 3,400 at this point is even possible for the S&P. Yeah, and I just said a minute ago, I think 3,300 would be within 10% of that 3,600 number. So 3,400, 3,300, 3,240, let's call it, would be the bottom for me. All right. Sparks just says, ask Michael Burry. Yeah, that's true. But yeah, Michael Burry's a bit of a perma bear, though. He always thinks everything's going wrong. So XBEV is so cheap right now. So the price of XPeng is very low, but is XPeng very cheap right now? That's the question you need to ask yourself. We aren't in a mode anymore where we're pricing those cash flows out as cheaply as they were when you could borrow money for nothing, right? We're also pricing in a little bit more economic instability for China at this point, as it looks like, they have economic issues that will need to be solved. Okay. And I don't know if you guys saw that over the weekend, there were rumors abound that China was having a political crisis, that there might be a coup underway, and that Xi Jinping was under house arrest. Now, this is all over Twitter. This was all over like TikTok, and I got a couple questions on it. But I'll be honest with you guys, I went and looked on, and one of the claims they made is like 59% of flights had been canceled out of Beijing, and that would be a really good sign. So I went on TAR and I looked it up, and there was no sign at all that any of those flights had been canceled. And I started looking into the news about that, and it was just that Xi Jinping has been out of the public view for a few days, but it makes sense because of their quarantine rules that he just went to Kazakhstan, rubbed elbows with a bunch of other world leaders, and who knows how many people in the press. It makes sense that he quarantined himself when he came back from Kazakhstan. He did that basically. I don't think he actually cares about those rules that much, as none of our leaders seem to. I think that he did it just to say, hey, I'm complying with these rules as well. That's the reason he's been absent from public view. And I don't believe that any of these rumors that were started now. Chinese politics is kind of the blackest box out there in terms of the politics of any country. We really don't know what's going on with the internal politics of the country because they are not public. Even other autocracies seem to hit about of so it seems to be even other autocracies seem to be a little bit more transparent when it comes to their politics. But in this case, it was kind of, the way it was framed was kind of compelling, and I kind of understand why a lot of people fell for it. But a little bit of an investigation would show that the only news sources that were carrying it were Indian news sources. And if you've ever watched Indian television channels, actually, because I forgot that everyone who watches the news is driven by politics. If you're a rational person and you watch any of the Indian news channels that are out there, you will quickly realize that they aren't the slightest bit rational when it comes to reporting the news, not the slightest bit. And I know that someone's going to get offended about that, but that is simply my experience. And I've watched a lot of Indian news sources, especially when it comes to the Ukraine war, because I wanted to get alternative perspectives that I didn't share. And a lot of it was yeah, it wasn't very good journalism in my estimation. So um, somebody did post something like that in my Patreon that it looks like it appeared with a Falun Gong cult member somewhere. Not that I'm that familiar with that particular cult. I do know they have been persecuted by the Chinese government. Yeah, Redshift says saw it but didn't believe it. A lot of people believed it, and I thought, man, it would take 5 minutes of investigation to see who is seeing that saying this. It's only showing up on social media. It's only showing up on Twitter. It's only showing up on TikTok. And the only news sources reporting it are India, which they just had a giant border spat where a couple of hundred soldiers got killed in 2020 with China. And the Indian media is not generally known to be fair at all to people that they are, anyway, just what I was looking at. It didn't seem to be remotely believable after 5 minutes of news. But that story showed up over and over and over on my different news feeds over the weekend, which I thought was kind of wild. Um, so it ain't news yet. It's propagated by the West to be carried by. It wasn't carried by mainstream media at all. They didn't mention it at all here in the U.S., and that's one of the reasons I had to go and look for it. And I found that, like I said, the only news sources that were reporting it were Indian ones. And a lot of people don't know they're Indian ones because they're in English, of course. But no, it wasn't actually propagated in the West, other than through social media. And there's all kinds of crazy things propagated through social media that people think are true. It's not just about the news media. Think about how many people believe the world is flat based on ideas that are propagated through social media. Oh, well, I just lost a few hundred followers there probably. So anyway, because I don't believe the world is flat, because I've been on the ocean before. Anyway, yeah. Interesting. Was being fed to me by Reuters Sunday AM. It must have been like super early because I didn't see it at all on anything in Western news. Nothing at all. And even some of the Indian sources that I saw they were like, this is completely unverified. And then there was even some video posted of military vehicles supposedly moving towards Beijing, but there was no way to tell on the video whether that was stock footage from years ago, whether they were actually moving towards Beijing, or whether it was actually Chinese tanks in China moving anywhere, or it could have just been random stuff shot on shot with a cell phone. But no, it wasn't remotely believable at all. But I had actually a panicked phone call from a friend of mine saying, "Oh, should I sell out my Chinese investments?" I'm like, well, you might want to do that because of what's happening in the Chinese economy. But in terms of this case, I don't, especially when Xi Jinping, everyone has the opportunity, or at least the Communist Party has the opportunity to vote him out as leader, I think next month. And there's already sort of a designated successor waiting in the wings there. So, yeah. So anyway, let's talk about some of the stocks that you guys want to talk about here. And this is one of the ones I've had mentioned a couple of times. And I'm not doing another video on this one largely because I've been doing due diligence for some clients recently and on another business idea. This has been taking up a lot of my time. But I did go back and take a look at OpenDoor Technologies. I did a video on them. I think it was almost 2 years ago. And I haven't done an update on them since. And of course, this is a company that has absolutely gotten smacked down. It is a real estate technology company. They are basically, if you're familiar with Zillow, you're familiar with Trulia, you're familiar with OpenDoor. They all do something similar. We take a look at this stock. It is down so far this year. It's pretty incredible. Down close to 90%. Started at about $25 a share a year ago. It's been down as low as 285. The market cap is 1.924 billion. The beta is pretty high. It doesn't have positive earnings. It has not had positive earnings. I will say one thing though. They do have about $8 billion in cash, and their burn rate is a little bit slower than I would think that it was before. And when I'm taking a look at their earnings here, they don't have runaway costs in terms of the earnings. Got about $8 billion in revenue and negative $662 million in earnings, which is to be expected. So, which is to be expected with a company in growth in growth phase like this. I think though, although I'd love to snap up shares of this, and think that it's going to return to $20, $25 a share. There's no guarantee of that, of course, but also we're in a transitionary period right now where I need to see what their portfolio is doing, like how, with the properties they buy, how fast are they able to turn them around and take them off their balance sheet? What kind of losses are they taking on those right now? And we are going through a period where something is going to happen with the real estate market right now. I did an illustration in the last video that I released last week that showed just how much more expensive it was for someone to buy a $500,000 house now than it was the beginning of the year. And it's about $800 more expensive, right? Your payment is now $800 more a month. That's almost a third more than it was just the beginning of the year. And how that means you can afford less house. You can now afford where you could afford $500,000 in house at the beginning of the year. Now you can afford $375,000 in house. That's it. That's because the interest rates have reduced your buying power. The other thing that I'm seeing on the market right now is the market is starting to fill up with homes. There's more inventory. It's not that it's full, but there is more inventory than there was last year, but it's about 20% higher. But that the sellers in this case have unrealistic ideas about how much their home can sell for. This is actually a recipe for a crash in home and housing prices. The fact that interest rates are simply going up means that housing prices will probably come down in response, or at least won't grow at all, or not as quickly, even if we do have inflation. But the fact that inventory is starting to pile up right now and that asking prices are still so high, we're seeing massive reductions in housing prices every week. This is a really, really big deal, guys. So there's a crash in housing that's going to happen. But that crash in housing doesn't necessarily mean that it's any cheaper for you to get into a house because of how high interest rates are going to be on a mortgage. By the end of the year, they're going to be even higher. So, oh my God, there's a comment here that I really, really don't want to address, but I'm going to address it. I really don't want to. Okay. So real news of that sort would make a much bigger splash in Western media. Yes, and like I said, it didn't come from anywhere official. It was that news that there was a coup in China just snowballed on social media, and that was it. So then there's Nautilus down 73% year and trading halted for some reason. We'll have to take a look at that. But back to OpenDoor Technologies for a moment. This company is, at least in the immediate term, not in danger of going bankrupt because of the amount of cash that they have and the fact that their burn rate is actually fairly low. They lost about $330 million just in 2021. In 2022, I expect that number is going to be higher, but let's remember, this is a company with $8 billion in revenue. If they've lost 30% of their business, they're still, roughly $5.5 billion in revenue. In terms of their expenses, like I said, they've been able to cut expenses pretty significantly. So, Ape Love Ape, please do an analysis on Nano Dimension. Meet Kevin said it can 100x. So, let's talk about that. I don't really watch Meet Kevin. I watched a couple of times just to see like how he made his videos, why he was so popular, and then I realized I can't do any of the things that he does. For a couple of different reasons. Number one, I'm actually a licensed, financial advisor. Number two, I don't want to lie to people. I'm not saying that he does all the time. I'm just saying that I don't want to lie to people. I talk about possibilities. I talk about this, but I would never go on to a YouTube channel and say something can 100x. Of course, everything could 100x, but in terms of Nano Dimension, it probably won't. And I understand the technology probably better than most people at this point after looking at it for a couple of years. It is a very neat technology. It's going to be it's great for a company that's prototyping printed circuit boards. How many companies prototype printed circuit boards? Are they going to benefit from reshoring technology here in the U.S. When it comes to circuit boards? When it comes to semiconductor chips, I don't know about semiconductor chips, but definitely when it comes to circuit boards, they can benefit from that. But can it 100x from the levels that they are at right now? They already did one reverse merger before they actually had that big thing where they got popular. They are heavily diluted at this point. They've had a number of secondary offerings at this point to dilute again. But here's the biggest reason why I'm not as excited about this company as everyone else is that they actually have the best looking 3D printer of this type for printed circuit boards that anyone else has. The problem is that they no longer hold any sort of advantage whatsoever. Their advantage was in the patenting of a dielectric ink, not in the process of 3D printing or anything that. And when I looked in December of last year, now they had like 5 new competitors in the business that all had cheaper units and all had their own dielectric ink that was patented. It was just a different dielectric ink. So their basic business model is to become the HP of 3D printing for printed circuit boards, right? It's still cheaper to manufacture circuit boards the old way for anything in large volume. So you're really looking at these printers providing for, let's say you need 1,000 of these printed circuit boards and you're probably never going to make any more. It might actually still be more cost effective to go to a traditional printer and say, hey, please set this up for me on your factory. This is like this giant setup cost for, not giant, but there's a significant setup cost to get a production line to do that. When it comes to this 3D printer with the Dragonfly 3D printer with Nano Dimension, you just slide in the program and it can print out 1,000 of these, but you're going to lose money based on, you're probably going to lose money on that in terms of volume production because they're not any cheaper. It's like the difference between direct-to-garment printing, the stuff that you get like, was it like the ship on demand or drop shipping T-shirt websites versus screen printing. If I'm going to sell 10,000 T-shirts, it's a hell of a lot cheaper to screen print them than it is to go DTG, right, direct-to-garment printing. It's the same thing with these circuit boards. If I need to deliver 100 of these circuit boards to someone for prototyping a project, it's cheaper to go with the Dragonfly printer. If I need to produce 10 million of them, it's cheaper to go to the traditional chip manufacturers, right? So, and the other issue is that now they have 5 competitors, at least 5, maybe more. So yeah, no. So that's kind of my deal is that I'm not that excited about that for that reason. It's not special. It just isn't special. So if you have it in your portfolio, I would make it a small percentage of your portfolio. And they would need to prove that they can actually grow their revenue. Right now, they're still reporting news every time they sell a single printer. That is not that's not indicative of a company that's gonna 100x anytime. Like I don't know when he would have said that. Yeah. So me, Kevin, never said anything about 100x. Yeah, not necessarily the language I'd use on my channel, but hey, I do that in real life all the time. But no, I don't know if he did or not. Like I said, I don't pay that much attention to Meet Kevin. Like I was actually stunned at all the hit pieces out on Meet Kevin. I have no idea what has happened. And to be honest with you, I don't really care about digging into what other people think is scandalous about Meet Kevin. I understand he got a DUI, but that's not the reason everyone's mad at him. Everyone's mad at them for something else. And then I saw one video that talked about him being unfollowed on Instagram. I've never even promoted my Instagram because I don't really care about it. So Instagram is monetizable by a select few group of people, and those are usually extremely attractive ladies. But men talking about finances aren't able to monetize Instagram, so I don't go on it very much, and I'm not going to do it just for vanity's sake. So, yeah. Yeah, look at them now. They got 1.3 billion in cash, cap and only 600 million. Market cap of only 600 million. And that's like I said, they utilized that period. Nano Dimension utilized the period when their stock was high, like on the 6s, 10s, 12s, to do secondary offerings to build up their cash position. I think they knew that they had an opportunity right there to build a war chest. And they could use that war chest to ride out some bad times, to make some acquisitions, and possibly gain a lot more in the way of market share. The era of doing that sort of secondary, this sort of secondary offering is over at this point, right? It's going to be good for that. I mean, it's at $2.40 a share. So I think I remember buying it at like something close to that and then selling out at like 6 or something. Some of the few short-term trades that I do that I've done in the past, just because I recognize it as being hype. Like
I like the technology. It's really interesting. But yeah. So 3D printers are a dime a dozen, commodity hardware. No. So the idea though with Nano Dimension, because of their specialized product that they print, which is it's a circuit board, so it's a conductive ink. The idea was to take HP's model where you are going to sell the printer for dirt cheap. Your margin is in the ink, just like it is for HP. The problem is you're right on this with Nano Dimension. Is it like how large is that market? How large is that market? So I just don't know. And that's one of the things that the other guys that you see on YouTube probably present things with a lot more certainty than I do. I don't present things with certainty. This is going to happen. That's not going to happen. Whatever, because it's not actually certain. It's all probabilistic in my mind, and it's all probabilistic in reality. Okay, I don't know what's going to happen. So yeah, and Sparks Interest says, I wouldn't trust Kevin like that Stockmo guy. Stockmo probably sell his brother for $1 if he can. It's another guy I've never watched one of his videos to completion. And largely he has a legitimate background in working as a financial advisor, but having a legitimate background in working as a financial advisor or stockbroker doesn't mean that you actually did anything that would benefit your clients. And let me tell you why. There's a huge difference in doing what's suitable for clients and being a fiduciary. And I've learned that. It took me a long time to learn that. I was a financial advisor, just like everyone else, at your wirehouses and bank brokerages, where I was on a commission and I sold things on a commission. And you justify in your mind that you're doing what's right for the client. But in the end, you go back and look at it a year later, you're like, I really did it for the commission, right? But in your mind, and it's all documented, it's all perfect. It's all done and it's all above board according to the rules of that time. When you operate as a fiduciary, it's a completely different story. You act solely on behalf of the client. There isn't a commission element to it. You're paid a flat fee generally, or for assets under management. So, yeah. Let me see here. Alan Gomez says, Meet Kevin did buy Nano Dimension. Yeah. Nothing to buy until after the big capitulation in the coming months. Yeah, I'm not sure that we've maybe not partially seen a capitulation already. I was reading a good article on that. So how that retail investors have started bailing out of the market as early as July. They were really bailing out of the market pretty heavily. So Rivian. My problem with Rivian right now, Redshift, is that I want this company to succeed. I want this company to succeed so much because I like their product. I like the Americanness of a pickup truck, and I wanted them to succeed. The problem is that I actually see a really narrow pathway for them to succeed. Ford really kind of screwed them over in a way by divesting themselves of their investment. They essentially used them for technology. They used them to raise money to pump into Ford's own production line. I really thought we'd see more of a partnership between Ford and Rivian in terms of technology production and maybe like brand sharing or something like that. Unless they are able to raise money, I think they're going to go out of business. And they got to be able to raise money from private equity or raise money on the secondary market with stock offerings. Tesla was able to do this in economically dubious times, like in 2011, 12, 13, 14, 15, 16. And every year they were able to do either a convertible bond issue or a secondary stock offering, and usually both. So Rivian's options that I think are most likely right now in order to, and they've got, God, don't quote me. It was either 8 or 16 billion when I looked up on there. Don't quote me on that because this was a few weeks ago. I don't remember the exact numbers. But Rivian had either 8 or 16 billion dollars of cash on hand. They're burning through it very quickly, though. But they had enough to make it to the end of the year. And this was a few months ago. And they just secured a little bit of funding a few months ago also. But I do think that you're probably going to see offerings of convertible bonds in the future here with interest rates rising. You get a lot less in the way of, you pay a lot less in the way of interest on a convertible note, because in the event that the price of Rivian rises above the strike price of the convertible bond, that bond can be converted into a specific number of predetermined shares at that strike price. So it lowers the interest that you're paying on that debt. I think we're going to see more of that from all of these growth companies at this point. And it's going to be particularly more prevalent in anything where there's where the order of payout in case of bankruptcy makes a difference. Meaning that if you did this on SoFi, if SoFi issued a bunch of convertible bonds right now, it's not going to be such a great deal because in the event that the company liquidates, other than their banking operations, there's not a lot that can be cut up and sold to other companies. But if Rivian were to go out of business, there are physical assets and property that can be sold off. And there's a possibility that you might recover some of your money in that respect. So you're going to see companies like that have like industrial assets. They're going to start issuing these convertible bonds. These convertible bonds may actually be something that you want to take a look at. You're going to get a minimal, Tesla was able to issue them at 0% interest, that's off the table now for these other companies that are coming up. But they may be able to borrow $800 million and pay 3% interest on it with, Rivian having like a $60 strike price or something like that. So that is something that's definitely on the table here. And Jared says they're burning through cash really fast. Jared, who's Jared? Sorry, guys. And good point. Re-forward. Let's still walk. Been warning people since the beginning of the year. The real puke is not even here yet. Yes, we've seen we're down close to 20% by about the end of June. Made a little bit of recovery. We're down at close to 20% again. I think we'll probably see another recovery and then a third dump at that point. And that third dump would probably be the big one. I think that the market is, like I said, it's priced in that interest rates are going to stay up for a long time. And it's priced in the reality that there isn't a way to stop inflation without having a recession. And I think that's the question now is how deep is the recession going to be and how long is it going to last? I am of the opinion that it's far better for us psychologically as a country and for the whole world to make it short and make it sharp. I'm on the side of, instead of having 5 years of 5 or 6% employment, let's have 1 to 2 years of 10% unemployment. Get it over with. Yeah. So Fed still has trillions to take out from the FBS. They've only got about 100 billion against a target about 230 billion by the end of September, and trillions more. The target for them is about 100 trillion, is only 1.2 billion per year. And you are right. That is a bubble buster. That's going to suck money out of the economy. That's exactly what the Fed wants to do. It's a bubble buster as well. And a lot of folks don't realize what's happening here. They're allowing the cash or the bonds to roll off the balance sheet. Normally what they would do is take when that rolls off the balance sheet and actually pay the principal back on that bond. Normally what the Federal Reserve would do would be to go right back out to the secondary market, buy an existing bond. When I say normally, it's only been since 2008 that they've been doing this. So for the last 14 years, at least, they would go back out to the secondary market. They would buy another set of bonds, and that cash would be back out in the system. Now they're essentially going to be hoarding cash instead of, and they may do what Paul Volcker did, which is shocking, which is actually just burn the cash, which I think would be awesome. And a lot of people don't realize that there were hundreds of billions of dollars in physical bills in 1981, 82, 83 that were actually just burned. They were recovered into the Federal Reserve and simply destroyed because that was the way to reduce the amount of money that had been printed. And it was also the way that they were doing that was by having really high interest rates and attracting investment from overseas. We've seen European central banks are already raising rates. Central banks across the world really are already raising rates in order to keep up with U.S. rates, not simply because they want to fight inflation, but also because they don't want all of the investment dollars sucked out of their country and coming to us because our fixed income rates for are we AAA anymore? For a AA lender are still so high. So, so it's balance sheet roll off at this point. They haven't actually started going out there and selling securities. They're just allowing balance sheet roll off at this point. And it's not clear if they're really doing everything they said they're going to do. So, yeah. Google's basically debt free with a P around 18 and still projected to go lower. I'm planning to accumulate during this bear market. See, that's what I'm talking about, George, and the type of investments that you probably should be looking at right now. So I typically used in the past to value Google. The price to earnings growth ratio is really what I would use to value Google more than anything else. And it's been really, I've been using that ratio as my core to find a value for Google since about 2011, where it was pretty clear that they were no longer just a company, they were an institution. And that's true. Google is basically debt free with a price earnings ratio of around 18. And I think it's a very, that's one of the stocks I'm talking about where Google is a technology stock. It's still a growth stock, possibly. But when you're looking at this period right now, you have to actually consider it a value stock based on the historical price to earnings ratio and based on its positive cash flow fundamentals. And I would definitely acquire, I'm definitely going to think about acquiring Google myself. But that's exactly the type of stock we're looking for in this recovery. Some of the stocks that we liked last year that may have had a chance with a longer bull market, and really I'm thinking a Rivian in particular here, they're actually in danger of eventually going out of business. And I think Lucid is in danger. Rivian's in danger, not immediate danger, guys. A lot more has to happen. But other companies though are just, they're going to go. A lot of these electric last mile companies, they waited too long to go public. They don't have the opportunity to raise money anymore, and they're going to get bought out by Amazon and by FedEx at rock bottom prices, and the shareholders are actually not going to get a lot of return out of it. Not what they were expecting, at least. So actually looking into shipping and mining stocks on lower prices. So be careful with shipping, especially with dry bulk shipping, which oddly enough, a lot of those companies are actually owned by Greek families, but registered in Panama or in, and I can't remember where else they're registered, but it's in Panama, like Ivory Coast or something like that. But they're registered in these countries where they pay low taxes. The corporations are registered in those companies, well, not just the ships, but they're owned by some of these like really wealthy Greek families. Dry bulk shipping spiked prior to 2008 to like ridiculous levels. Every stock was paying like 12 or 13% dividends. The bottom dropped out of dry bulk shipping, and it has never recovered in terms of stock prices or dividend payments. So be very careful when you're taking a look at those. And I wouldn't necessarily look at the health of any individual company. And because there's so much nepotism and corruption in that business, I would look at the entire industry for health. And that's what I would look at. So Blunt says, what do you think about XPeng for this price? So Neo, I've been trying to divest myself of my shares of Neo for a while. I have sold some of them. XPeng I decided to keep as a calculated risk. I think that of the newer sort of startup EV companies, XPeng is in a much better place in terms of their manufacturing capability, their product lineup, the breadth of market that can actually sell to based on who they've based on how they've decided to manufacture. The only company that's in better position than them is BYD, of course. And Neo is not a bad company. I just think that XPeng is better than them. But at this price, like this is not a profitable company, and there's no real hope of profitability until at least the end of 2024. And I would probably have to extend that a little bit further with disruptions in the market. Things could radically improve. I would like to add more XPeng at this price, but I'm a little afraid to. I already own a significant amount of shares of this. I'm already down. I think my average cost of acquisition is around $26. And I've had this for a couple of years now, and I got in like really early. But yeah, I think that is something that I'd like to, but I'm a little afraid at this point because it already makes up a significant portion of my stock portfolio. Attention, what do you thought on Meta still dropping P/Es around 11? So this could turn out to be a really huge story. Like Facebook, Meta could turn out to be a really huge story. So I think that the idea of the metaverse, or the idea that there's going to be multiple metaverses, and the idea that VR, and particularly AR, augmented reality, mean we wear glasses where we exist in regular reality, and we see an overlay of things that are displayed to us, information that we need. We use it like AR glasses, like us for cell phone, for texting, all that sort of thing. I think that is going to happen. But is Meta making that pivot a little bit too early or a little bit too late? That's what I'm a little unsure of. And are they ultimately going to be successful? Do they still have the cool factor to pull this off? And that seems to be one of the big things about Facebook's Meta universe right now, is that it's just not cool and it's not attracting a lot of interest. And yeah, I couldn't find my regular coffee cup this morning, so I'm using one that says all I care about is Brazilian jiu-jitsu and maybe like 3 people, which some days is true. But just based on price to earnings, this is one of those cases where I talked about using PDE to value a company, whether or not that's outside the norm. And because of the fact that, when rules around price to earnings ratios were designed, that was like the 1950s. That was back when, if you wanted to find an undervalued company, you would have to actually thumb through thousands of pages, well, not thousands, but hundreds of pages of actual like stocks to find something that the market ignored because they just didn't know that it existed, or something like that. That's kind of no longer the case. You can go to any website out there and just type in low price to earning stocks. You're going to get a list of those, and you can sort them any way you want to. And so that begs the question, are there really any truly undervalued stocks based solely on price to earnings? And I said, there's undervalued, and then there's undervalued based solely on price to earnings. I think PDE is not the only evaluation that you can use to see if something is actually undervalued at this point, because you could fall into the value trap, which is you buy something because it looks undervalued, but later on down the road, you see earnings adjust to show that undervaluation was actually totally justified. So there's a lot of that, and that's something we should definitely think about. But in terms of Meta, I'm not giving you guys a lot of definitive answers today, and it's because there's not a lot that's definitive out there. The only one that I was like, yeah, I'm probably going to do that is Google, right? For me, that's just a friggin' no-brainer. PDE around 18, projected possibly to go lower. Accumulation here. On Meta, though, it's a definite 100% maybe. Okay, and a lot of that is because the pivot to the metaverse. I'm not convinced that they can do it successfully. I'm not convinced that they don't get disrupted by some other player that's out there. I'm not convinced that Facebook is a different animal than TikTok, and it's a different animal than Twitch. It's a different animal than YouTube. They're all considered social media. I'm not convinced that the way we interact with Facebook disappears. Like, I actually had to get rid of the Facebook app on my phone because I just spent so much time on Facebook insulting people that I knew. So I ended up getting off of Facebook, which is a good reason why I'm not on Twitter as well. I'd spend a lot of time on Twitter battles with people that don't make any sense. This is a much more, this is a better environment. Basically, I'm attracting people that are interested in talking about the things that I'm interested in. We can talk rationally about stocks and things like that. So, but yeah, what I'm saying is I'm not sure that social media will be around in the form that Facebook is in today. And if social media goes to the metaverse, I'm not sure that Meta is the one to do it. So there's a lot of other companies that are out there. So yeah, that's very interesting. I had dozens of questions last year about Matterport. Looked at the company, saw a lot of what they were doing, but didn't see a lot about how they were monetizing it. The last 3 weeks, I've been working with some commercial realtors, looking at properties. I've been bombarded with stuff that's been coming from Matterport. So I will say that in terms of real world application, I'm actually seeing it show up. One of the other investors that I'm working with didn't even recognize that's what we were using was Matterport products. We were getting the property listings through our phones. But that's one of those things that I'm moving from science project and pie in the sky to a company that I'm going to be paying more attention to, Matterport. So Jay Powell said, trying to hit 4.5, 4.75%, right? And the rate right now is about 3%. So probably raise 2 more times. and then smooth out from there. And what are those dates? So the market, or not the market, but they've talked to a bunch of financial advisors, and about 80% of them said that by end of 2023, they expect rates to be between 4.5, between 4 and 4.5%. Right. Powell came out and said he wants them between 4.5 and 4.75%. I think that he gets pretty close to there by the end of the year. I think we see 2 more raises at 0.75%, and he pulls off the gas and moves to raise about a quarter point per quarter after that. The market is, and when I say the market, I say they've done a survey of financial advisors. And I'm not talking about people like me. I'm talking about people that work for like big corporations that are advising a bunch of like hedge funds and advising a bunch of pension funds. Pension funds are the real movers. What they think about interest rates. They think that interest rates will be lowered by about 1.25% to 1.75% in 2024 and 2025. That I think would be overly optimistic about how much we're going to have to do to fight inflation. G. Powell right now is saying is implying that if we hit interest rates of 4.5 to 4.75%, that's going to raise unemployment by 0.8%. I do not buy that argument, and I don't think that he expects professionals to buy that argument as well. I don't think he expects people in tune with the financial world to buy that argument as well. I think we should be planning for closer to 5 or 6% unemployment by next summer. I think it should look pretty not bad, and that's not bad at all. 6% unemployment historically is not bad at all. That's about the average unemployment rate of the 1990s. Okay. And I think that is something. It's not in a lot of other administrations. That's something that you shot for was 6% unemployment. I think that unemployment will be a little bit lower because the size of the workforce is a little bit smaller than it was in the past. But yet our economic opportunity is so much larger. Yeah. Let me see here. Undervalued stock. I'd ask Mr. Buffett. Well, so Warren Buffett actually uses a different valuation method, reportedly. We don't actually know what he used, but for a lot of his more established companies, he uses the dividend growth model. And that's something that I'll end up doing a video on at some point, as I'm working on videos for all of these valuation metrics right now. But he uses the dividend growth model, and which is very good for any company that has established earnings and pays a dividend. So what do I think about Micron? It's kind of interesting that you asked that question. Micron is a company that I prefer just to own through an ETF, right? And largely the chip industry, aside from taking a concentrated bet on NVIDIA here, and I am still acquiring shares of NVIDIA at these prices, for the rest of that whole sector, I'm happy to just own an ETF on that. Individual companies are so incredibly volatile. We've actually seen a period where chip companies have not been so volatile over the last 3 or 4 years, and it's lulled people into the sense of complacency, and they don't realize basically if you're going to invest in the semiconductor space or any sort of chip space whatsoever, it's like trying to row through a hurricane in a 15-foot rowboat. A lot of cases, trying to sell out at the highs and not get crushed in the peaks is very, very tough in the semiconductor industry, and it happens all the time. So the fact that we're going through a bit of a transition, so there's not a ton of evidence right now that the CHIPS Act has really spurred this giant reinvestment in chip manufacturing in the United States. I think it's going to take about a year for us to understand really whether or not there is this giant reinvestment in there. And I want to see that happen. But for the majority of the semiconductor industry, like I said, because of its volatility, because of the highly technical nature of this, it's very hard for you to understand every product that every company has. I've chosen to just concentrate on NVIDIA. And like I've said before, even with that investment, every option strategy I've ever employed has blown up on me, which it literally it's probably going to do it again here pretty soon. I sold a put Nvidia at 120. So I'm about to own 100 more shares of Nvidia once it crosses below 120 at some point. But what do I think about Micron? I think Micron's a highly volatile stock. It's a good company. Is it a great company? I'm not really sure, but it's a company that I'd probably prefer to own just through an ETF. So I know you're interested in MoneyLion, but there's so many payment companies right now. I'm having a hard time understanding if they can survive in the space. So MoneyLion is not a payment company. And you are rightly concerned whether or not MoneyLion can survive. There are companies that are definitely going to go out of business in this space. MoneyLion, though, has concentrated on having a pathway to profitability, and they are looking at being EBITDA positive by the end of 2022. That's what they are. That doesn't mean they're profitable. That just means that before, like earnings before interest, taxes, amortization, and whatever else is in EBITDA, they're going to be positive at that point, which means they're almost profitable. And it's really going to be their investments that make them unprofitable at this point. But a large reason that MoneyLion could be really successful is that their acquisition cost for their clients is about $20 per client. Their revenue per user is about 70, right? So average revenue per user is about 70. And their costs really aren't much above that. And then once a client has two, I think that the average revenue jumps up to like 160. And once they have three products, jumps up to like 240. And that's the thing, is almost everyone is getting 2 and 3 products through MoneyLion. And a lot of it has to do with their content, right? Their social media content. There's a huge social media element to their app where they have all of this education that drives more purchasing and financial responsibility. That's actually something that SoFi employs too, but they haven't put as much concentration on that. That's where MoneyLion is doing really well. And MoneyLion and SoFi, in terms of platform growth, MoneyLion actually outperformed SoFi in terms of acquiring new users in the last period. But SoFi financially, they looked better. But MoneyLion is a much smaller company. It's going to be much more volatile, and it's a much bigger risk. I did buy a butt ton of shares in this company. I think I'm over 13,000 shares now. But I did it at all under $2 a share, and most of it close to $150 a share. And I'm perfectly willing to sit on it for a couple of years. And I think that I'm going to get a multi-bagger return here if they survive the next 2 years. And that's a question. Will they survive the next 2 years? I think they have a better chance than a lot of these other companies that are out there because they've really concentrated on having good fundamentals. And like a company right now that I will predict is probably going to go out of business despite all of the new partnerships they've announced, Skills. They're done, man. I think they're going to be done. And I talked about this in my Patreon group too. Like there's another website that I go to. I can't think of the name of it off the top of my head right now. Where we talk about where they talk about the chances that the company is going to face financial distress. And so they listed SoFi at like 77%, and that's based purely on numbers. And I agree with that. But SoFi is a company where you have earnings growth, and you have earnings growth that's not decelerating all that much. When you're looking at Skills, you're looking at earnings growth decelerating and costs just exploding for this company. I did some due diligence for someone, and I was actually paid to look at it, paid to give my opinion on this company, and not paid to say buy, sell, or hold, just say, what is my opinion on this company? And based on their exploding costs and their declining growth, and the fact that we're actually seeing companies like Roblox, or they don't have as much engagement. Anyone engaged in mobile gaming doesn't have as much engagement as they did. 77% with SoFi. Remember, that just means financial distress. That doesn't necessarily mean chances of bankruptcy. Okay, they didn't have chances of bankruptcy on that. But for what was it, for Skills, they had 73% chance of bankruptcy in the next 2 fiscal years. Okay. For SoFi, it was 77% chance of financial distress. I would say that they're already in financial distress for a variety of different reasons, most of them being macroeconomic here. But no, I'm still a huge SoFi bull. I'm still, My wife won't let me acquire anymore. So because we have too much at this point, we have too much in SoFi. So I'm not acquiring any more SoFi. Anyway, but yes, and Sparked Interest says, thanks for the answer. I am out of time to eat. Take all your luck. Thank you very much, Sparked Interest. 77%. That is terrible for SoFi. It is. If Anthony Noto quits, my nightmare. You know what? That actually could be a nightmare for SoFi, and it could be. He has provided such an old school gravitas to a team, to like a really young team and a really immature idea, right? He's provided this old school gravitas to that. And if Anthony Noto were to quit, not a ton of indication that he would, since he keeps acquiring shares, he keeps buying shares. If he were to quit, I would hope that they would replace him with someone else who's older, more mature, and carries that sort of old school gravitas with them. And that's one of the things that's been missing from a lot of these fintechs. They just don't have anyone that's been, and I think that's one of the things that's missing from Upstart is that's another one. You look at price to earnings growth ratios. The reason Upstart got up to $400 a share is because of their 1,000% increase in revenue in a year, right? But it should have been expected that revenue growth couldn't continue. When it got to $150 a share, I will admit that I was excited about it. If they could continue to grow, I mean, I knew they weren't going to grow at 1,000% per year, but if they could continue to grow $150 a share, I was kind of excited about it. But waiting, when it hit $75 a share, I was like, oh, I want to grab some. I literally like ADD, got distracted, forgot about Upstart, and didn't buy any until like 26 or something. And then, but since I bought some, it really hasn't gone. It's gone up to as high as like 37. It's been as low as like whatever it is today, 21 something. But this is another company that I am acquiring. The lending business, it's just a good business to be in as interest rates rise. It's a very good business to be in as interest rates rise. People will not stop borrowing money. They will still borrow money. They're just going to have to pay more to do it. And especially companies like SoFi that have a bank charter as well, they're really going to start benefiting from that credit spread. They're really going to start making a lot of money from interest operations. All right, guys, we are coming up on an hour or so. I am glad that we talked about stocks. I will not be here tomorrow. I might be here on Wednesday. I will definitely be back on Thursday to talk with you guys, and I'll try to put out some more videos this week. But yeah, I did want to say thank you very much for attending today. As always, the super chat features are on. I didn't get any super chats today, but that's okay. I'll see you guys next Thursday. Thank you very much for attending. I really appreciate it.